Hello, my name is Greg Upton. I'm Associate Research Professor here at the LSU Center for Energy Studies. Welcome to our 2021 Gulf Coast Energy Outlook Kickoff. We especially welcome those of you who might not be familiar with the Center for Energy Studies, or CES as we call it. CES is a unique research unit at LSU, and that we were created by the legislature in 1982. We're mandated to provide energy information and analysis that responds to the needs of the legislature, public agencies, business and civic groups, as well as the general public. And the Gulf Coast Energy Outlook is one way that we fulfill this mandate. The majority of our funding comes from the legislature through LSU, and we also participate in funded research through federal and state agencies, as well as private companies. We pride ourselves in our diverse constituency and funding sources, and especially thank the sponsors of this year's Outlook. At the gold level, Phillips 66 and the Louisiana Mid-Continent Oil and Gas Association. At silver, Entergy, Enverus, and Koch Industries. And then at bronze, the Bristow Group. I'd also like to personally thank the approximately 100 individuals from industry, government, and academics that spent their valuable time speaking with me over the summer in preparation for this year's Outlook. While crunching the numbers and the modeling is very important, equally as important is this input from stakeholders. It wouldn't be possible without you, so thank you. A very brief agenda for today. I'm going to start off with discussing the uncertainties and modeling assumptions that we use in the Outlook. I'm going to then move into the different parts of the energy value chain. Then we're going to switch over to our Executive Director, Dr. David Dismukes, who will discuss industrial developments and energy exports. And then we'll switch back over to me to present the employment forecast, and then back over to David for some concluding remarks. If you have any questions, please type them in the Q&A on Zoom, and we'll leave time at the end for answers. As you consider asking questions, please keep in mind that the webinar will be recorded and posted online. The Outlook itself is now on the center's website and has also been put in the chat feature here on Zoom, so please take a look. One housekeeping item. As we discussed, as I refer to Gulf Coast throughout this Outlook, I'm specifically referring to the states of Texas, Louisiana, Mississippi, and Alabama, and of course, in terms of energy production from the Gulf of Mexico itself. So this year, there are really three big uncertainties that we had to think about. The first and the most obvious, of course, is COVID-19. This has had implications across the energy sector and across the value chain. The second uncertainty that would be a big enough uncertainty in a normal year is the presidential election. But perhaps most interestingly, this year, decarbonization has really taken center stage in that political debate. And so we're going to talk about what that can mean for the Gulf Coast energy industry. And the third that I think has gotten less press coverage and less attention because of these first two, but it's still a very real issue and really was the focus of last year's Outlook, is these trade negotiations with China that we're going to dig into a little bit as well. So let's talk about for each one of these, how we think about it and what's going to be sort of the big picture assumption that we're going to use moving forward into our different Outlook. So in the short run, COVID-19 has really created lots of uncertainty and volatility. The good news is that prices have seemed to stabilize, and we tend to be on a track towards recovery. But in the long run, when we think about how does this impact energy demand and the Gulf Coast energy industry in the long run, the first big thing to consider is that even pre-COVID, energy demand growth globally was coming from Asia and the developing countries. Countries like the United States and Western Europe have really seen flat demand growth because of energy efficiency and other things like that. And so that's really has stayed unchanged now. We still think that longer term demand growth is really going to come from those Asian markets. Interestingly, we've had a sort of a behavioral response that could persist into the long run. So in prior years, when I've worked on the Outlook and I've called mainly people in the energy industry, this year I sort of branched that out and I tried to call people that were just completely outside the energy industry but are at large companies. I talked to people at a large car manufacturing firm, a large insurance company, and even a company that has manufacturing in China and the storefronts in the United States with thousands of employees. And I asked these companies a simple question. I said, now that you've had COVID, You've probably had less travel. You've had less commuting into work, people working more at home. How much of this, if any, is going to persist in the long run? And I think what people have consistently told me is, well, we hope people will get back to work. We hope the traveling will occur again. But there's perhaps some of this change that's going to be persistent. Maybe not every single worker needs to come into the office 5 days a week. Maybe we can downsize our office space a little bit and have a little bit more remote work. Maybe we've gotten used to having these webinar meetings and these Zoom meetings for smaller meetings that we don't need to get in an airplane to go and meet for 2 hours kind of thing. And so in the longer term, we could have this. And then the third piece is that relates to the first two is the composition of demand. How is not only is it the level of energy demand, but how is that composition different? So for purposes of modeling, we're going to assume that COVID attenuates globally and the world is slowly able to return to some level of normalcy over the next 2 years. And in particular, transportation demand in the long run will rebound, but likely not to its pre-COVID trajectory, especially in the developing world, or in the developed world, I'm sorry. And so this sort of illustrates that with US employment. You can see this big change from COVID in the worst month, down about 13%. And underlying all of our assumptions is that US employment will return back to its pre-COVID level over about a 2-year time frame. The other big uncertainty, of course, is the presidential election. And so we get into the report itself. We talk about one thing in particular that's concerning, and this is the Joe Biden's plan to ban new oil and gas permitting on public lands and waters and modify royalties to account for climate cost. And so in the outlook itself, we really dig into what the leasing process entails, what the permitting process entails, and what regulatory changes could occur. We've talked with both people in the offshore industry as well as legal experts and asked sort of what is it that a president can do? And the answer we got is there's lots of uncertainty for how this would work, how it would play out in courts, et cetera. And so consistent with all of our methodologies, what we say is we are not going to take into account a proposed policy change until that policy change is actually enacted. And so in the event that this does occur, certainly our forecasts will be less optimistic, in particular for that upstream employment. The third big thing that's highlighted in the outlook is these China trade negotiations. And so the big picture point here is that the US and China did sign phase 1 of these trade agreements in January, and they went into effect on February 14th. We have a description of this trade agreement in the outlook itself. It's 91 pages. It covers a lot of different areas. Most notably for us is that there are specific import targets that China has agreed to. And also particularly interesting is one of those carve-outs is energy products. And so as you can see in terms of the dollar amounts, energy products are not the largest amount, manufacturing and agriculture are larger. But when you look at the amount of that carve-out relative to historically what we've exported, it's been very large. And in particular, makes up 20 to 40% of the an increase above what we've historically exported. Now, when you're tracking though, and the Peterson Institute has a really nice tracker on this, China is way behind in terms of meeting these targets. And so how this plays out with a new Biden administration and how those negotiations continue and whether or not they are able to meet those targets is a lot of uncertainty. So again, consistent with the prior point, we're going to assume that tariffs continue or do not re-escalate. We don't enter another trade war, quote unquote, if you will. And if that were to occur, again, our outlook would definitely be less optimistic. So now I'm going to quickly go through all the different facets of the value chain. We've got a lot more information on each one of these. And I'm going to sort of give the 30,000-foot view and tie it all together. So first, of course, oil and natural gas production and prices. U.S. oil and natural gas production pre-COVID were at historic levels and were anticipated to continue to increase into the future, as I'll show you here in a moment. The trend in Gulf Coast oil and natural gas production was similar. We were at historic levels pre-COVID, and both of those have been pretty negatively impacted. And so what's happened, of course, is you've had the West Texas Intermediate price go down, which is shown here of oil. The rig count has really closely mirrored that. In August, we were down to 250 rigs. That's a historical low in modern history. And it's bounced back now to about 306 in November. So we're going to take the view that the bottom is definitely behind us, and we'll show that in the employment forecast as well. But the amount of increased activity is not going to be enough to continue this upward trajectory of oil and natural gas production. I also want to point out here that this is the US rig count that I just showed in the prior graph. I want you to compare that to the Gulf Coast rig count and then to the Texas rig count. And if I were to move the title from these charts and remove the vertical axis, you wouldn't really be able to see much of a difference. They mirror each other very, very closely. But interestingly, when we look at the Louisiana rig count, it's very different, and it's been this sort of this more longer term downward trajectory. And so notably, the Louisiana rig count has become decoupled from the national Gulf Coast rig count and Texas rig count. In July, again, we were at an all-time low. Unfortunately, we don't see this really rebounding much in the future, and we'll talk about that a little bit more. And increasingly, Louisiana, while we're very much an energy state, is more exposed to the energy manufacturing, that refining, that chemical manufacturing, and the export of energy products all over the world, and less so in this upstream space than we were historically. And this is shown with well completions, even pre-COVID. We're sort of on this downward trajectory. 53% of the reduction in rig count nationally, notably, has come from the Permian Basin. And as we'll show, Texas upstream employment has been really impacted during this crisis. So this shows oil prices adjusted for inflation. And so I want to point out sort of three epochs here. In the late 80s, early 90s, and through the late 80s through the 90s, what you had was when you did an inflation adjustment, prices were really flat. They were relatively low and relatively not that volatile. And so while it's not really possible to predict what's going to happen to oil prices next week or next month or even next year, you could always sort of count on it coming back to that longer term trend there. In 2000s, everything changed. You had geopolitical risk, you had the wars in Iraq and Iran, and you had lots of not only high prices, but very high volatility. And then in the post-shale era, starting in 2015, we've returned to this low price and low volatility era. And as you can see there, of course, with COVID, we've had very low prices. But the important thing to point out here is that fundamentally, we think that we are still in this third epoch, this sort of low price and low volatility era. And oil prices, futures markets are saying, are likely to be between $40 and $50 a barrel for the foreseeable future. We see a very similar trend with natural gas. Again, you have these three eras. And again, futures markets are predicting that this will continue in the future. We've got a little bit of higher prices for natural gas anticipated next year. We talk about a little bit what that could be coming from in the outlook, and we can get into that later. But the bottom line is that, again, relatively low prices for oil and natural gas into the future. So now we're going to move into our production forecasts. This is based upon the Enverus Prodcast model, which is a really neat model. And what I've got here is our production forecast for oil for the last 3 years. So 2 years ago, we were anticipating that oil production was going to get to about 16 million barrels a day by 2030. That was considered a very aggressive forecast, very aggressive growth. Then the following year, the same model came out and said, no, actually, we're anticipating that we could be out to 18 million barrels a day by 2030. And so again, this is a really large upgrade to that production forecast. Now with COVID, this has really changed drastically, as you can see. And we're anticipating that oil production in the US is actually going to decline over about the next 3 years. While drilling activity will pick up, we're forecasting anyway, that the speed of that drilling is not going to be fast enough to offset the decline curve from the existing wells, and it'll sort of catch up in about 3 years. The Gulf Coast oil production, again, we see a very similar trend as we do to the national. Natural gas production looks very similar. So we were anticipating natural gas production to grow over the next decade or so, the last 2 years. And similar to oil, again, as that slowed, we'll see a reduction in production And it'll take about 3 years for us to reach that bottom as drilling activity picks up fast enough to offset that reduction that comes from the current production. And the Gulf Coast, again, it's a very similar trend there. So I'm going to talk, there's a long section in the GCO about midstream constraints. I'm not going to get into it as much here, but suffice it to say that what we're doing is we're really looking at price differences and midstream constraints in oil between the mid-continent and the Gulf Coast, as well as natural gas constraints in terms of gathering, processing, and then long-haul transmission lines from Waha, which is in next to the Permian bases, and Henry Hub here in the Gulf Coast. And the bottom line is that we've got a lot of pipeline projects that were really highlighted last year that we're going to, especially on the gas side, to bring that gas here to the Gulf Coast region for processing. The notable thing is that when I've talked to midstream companies, what I've been told is a lot of these projects have been put on hold. And so if the project is not under construction or FID has not been reached, they'll likely be pushed out. But nonetheless, this is the current announcements. Keep in mind that these will likely be pushed out a little bit. And we think that because of the declining production, midstream constraints will likely be less of a concern than they were 2 years ago. So novel to this year, we have a power sector section. So this shows total electricity sales in both the Gulf Coast and the US. And as you can see, US electricity demand has been very flat over the last decade. And a lot of that just comes because of energy efficiency. Our appliances are getting more energy efficient. Everything's getting more energy efficient. But in the Gulf Coast region, we've actually seen load growth. Why is that the case? Well, it comes because of those industrial load growth. And so as David's going to highlight in a minute, we've had billions of dollars of investment in the refining, chemical manufacturing, and export of energy products. And it's those industrial processes that have driven this load growth over the last decade. And so when we think, or over the last 5 or 6 years. And so when we think about load growth moving forward, that's going to really be tied to what's happening with those industrial developments. Notably, CO2 emissions per megawatt hour of generation have been on a downward trajectory, both in the Gulf Coast region and in the US. And not only per megawatt hour, but also in terms of levels. And so as we talk more and more about decarbonization, while certainly I think that this decarbonization is that we hope that will accelerate, at least the trend is in the right direction. And we see similar with SOx and NOx emissions. Again, the electricity sector has gotten cleaner over the past decade or so. So what do we think about plant capacity? So this is just based upon actual announcements that are out there. So we have about 54 gigawatts of wind capacity being planned right now and another 75 gigawatts in solar capacity. Keep in mind, this is about a 50% increase from what we currently have in the US and about doubling the capacity of solar if all of these projects come to fruition. And in the Gulf Coast, we've got about 18 gigawatts of wind and 33 gigawatts of solar. One thing that's very important to note here is that these are capacity numbers. They're not energy numbers. And so because these are intermittent resources, while you'll see a large growth in capacity, the amount of energy they produce is not as much. And so natural gas in particular is going to continue to be the dominant fuel source for the electricity sector over the next decade, even if all of these projects come to fruition. One last point I want to make about to tie in energy manufacturing and power generation is that, Louisiana has really not had just the geography for a lot of wind generation. This is very different than Texas. It has over 20 gigawatts of wind. They've got in West Texas. It's very large open plains with lots of wind. But Southern Louisiana in particular really has the opportunity to be a manufacturing base to support a lot of these renewable operations. One example of this, one anecdote, is Edison Schwest, who of course is a company that's supported the offshore industry for decades, has been awarded a long-term contract to build the first ever US flag Jones Act SOV to support the offshore wind that's likely to grow in the next decade up in the Northeast. And so that's one thing we're watching closely is how the Gulf Coast manufacturing base can support renewable generation, even if that generation isn't necessarily right here. So now very quickly, I'm going to talk about COVID-19 impacts on domestic energy demand. So electricity demand has been down. This is ambiguous. People have moved to home, away from the office. You might say, well, it's not really clear if electricity demand would be up or down. On net, it has been down, but the load and the residential load has increased, and commercial industrial has decreased, both in the United States and the Gulf Coast. Liquid fuels demand have been down across the board, which is unsurprising. Jet fuel has been hit the hardest. Diesel fuel has been hit the least, but is still down about 5% annualized. What we've been told about the refineries, very interestingly, is that you can actually substitute jet fuel and put it into the diesel market while making some modifications at the refining level. And so this has been a way that refineries have already started to adapt to that change in composition of demand, which I think is going to be a bigger theme as we move forward. And then finally, natural gas demand on net has been down. And as you can see here, residential demand has been up since April, which is unsurprising. Electric power natural gas usage has also been up. And the reason for that, again, is you've got these new combined cycle units that have been built over the last few years. They're starting to dispatch. And so we're seeing increases in natural gas usage for electric power generation. So now we're going to move over to David, who's going to talk about energy exports and industrial developments. Hey, David, you're on mute. If you could click on mute, please.
All right, let's try it again. There we go. Sorry, can you hear me now? So again, this is our chart that we typically look at in the GCEO on our historic trends associated with capital investment in energy manufacturing. You've got the distributions between Texas and Louisiana. I think some of the things to keep in mind as we've moved more into the more concurrent period and as we move into the future has been a bit of a shift. Prior to 2019 or so, these were pretty equally balanced between Louisiana and Texas. You see these numbers starting to move more towards Louisiana than Texas. And in large part, this has to do with the competitive advantages of locating a lot of LNG facilities here. So while it is a good thing for us in the state in terms of continued expansion, based on project announcements, a lot of those are going to be in areas that are somewhat speculative. Right now, we're looking at about $163 billion of CapEx remaining, but do keep in mind that that's what I often refer to as the bookend of development. That is all project announcements that are out there. As we know, many of those, particularly now, may not come to fruition given the changes in the economic environment. Again, this chart underscores looking at that whole portfolio of investment that we've seen historically, as well as anticipating to see in the future on where those investments are going to be. And you can see in the near term numbers on a projected basis and an announced basis, a lot of that being associated with LNG export facilities. So as that LNG market goes and as that export market goes, so too will go the investments that come into this region and how that drives a lot of other secondary economic impacts, particularly in the industrial construction sector, materials, wholesale trade, other things of that nature. One of the things that's important for not only energy trade, but also commodity chemical production is this differential between oil and natural gas prices. It's no small surprise that you've seen a big buildup of that differential in the middle part of this last decade, and that has corresponded with that large capital investment that we talked about before. Again, this has been our region's competitive advantage of using natural gas and natural gas liquids and leveraging those into developing a lot of new productive capacity, which in turn has been used in international trade pretty extensively. That differential looks like it will continue to hold, particularly as we move into the future, primarily based on the fact that we're going to have continued low natural gas prices, maybe a bit of a build in crude oil prices, which helps to explain kind of the small tick ups in the forecast period associated with that ratio. However, it has been a tough year for anybody that's in a capital intensive business. It's been a tough year for everybody, obviously, but it has been particularly tough in the energy sector and in commodity chemical manufacturing. You look at some of the big major names, from vertically integrated majors into large chemical companies like Dow, Eastman, Westlake, DuPont, all of them have seen reductions in the 15 to 25 to even 30+% level. As we look into 2021, those percentages are not going to be quite as high, but you're not looking at any growth. So I think if you look on a cumulative basis since 2019, as we've moved into the future, we're still looking at relatively low levels of capital expenditures in this sector. And you're probably going to continue to see that as most of these companies try to maintain cash, keep their balance sheets in order, service debt, and to keep strong debt ratings as they move into the future, given all the uncertainty that's out there right now. While the American Chemistry Council sees a forecast of growth and a return to normalcy moving into 2023 or 24, one of the things I would point to your attention is, the differential between this gold line and these purple lines, which essentially represents the excess capacity that's out there in the market. We've continued to see kind of some blow through on projects that are coming back online, or coming online, that were developed in years prior to 2020. That is going to create a bit of a margin here, an excess capacity situation as we move into the next year or two. And even in 2021 into next year, we're looking at still continued high levels of excess capacity. This is also, given the uncertainty and everything else, is going to put a damper on the willingness to put capital into this sector until things are better known. Based on current forecasts, we're looking at 23, 24 when this might start to pan itself out. But again, I would argue that outlook is certainly not real clear right now, particularly as we start seeing a surge in new cases, in the announcements for lockdowns in many parts of the world. Again, these are all trade driven, and as the global economy moves, so too is going to be this differential and excess capacity that we have in the marketplace. Going into tabular form and looking at these numbers and breaking them out between Texas, Louisiana, and the total Gulf of Mexico, you've got about 130 billion in LNG related capital expenditures moving through the 2029 time period. That stands in very stark contrast to the non-LNG investments, which are less than half of that at 52 billion. So again, these are on project announcements, things that in large part were announced prior to going into COVID. And it certainly raises a lot of questions about how much of this stuff in the LNG category will actually manifest itself and actually get developed. Again, when you're decomposing this between Texas and Louisiana, you can see a strong amount and bias of that being located in Louisiana right now. We have the leg up on those announcements at $89 billion moving through the end of the decade, 27 billion though in non-LNG oriented investments. Compare that to Texas, where you see a little bit more of a balance between 32 and 25 billion in investment in those two big categories. So again, that's what that outlook looks like. And again, as I mentioned before, this is mostly kind of on a bookends basis. This is everything gets developed in the time period that it has been announced. If it comes online in that time period, this is what you're looking at. Obviously, that is not going to happen. And one of the things that we've done, much like we did last year, is go in and look at projects and do some scrubbing on them based on who the developers are, whether they've moved to final investment decisions, whether they're close to that, particularly with LNG facilities, how much of the announced projects have contracts. Are they over 40%, 50%? In most instances, you need about 75% of that capacity to be contracted out to make it to a final investment decision. And you see a pretty substantial reduction in that amount, 89 billion down to about 41 billion. And even then, I think that's probably a pretty generous assumption. It's hard to throw out projects, but even some of the ones that have high opportunities for development, that have corporate experience in developing LNG projects, that have the balance sheets to back this up, who actually already have contracts, even many of those are at risk right now. And I think many of you probably know who those players are. And so, but right now we're looking at this year about a 50% scrub rate on that. Compare that to where we were last year with the GCO, where we're looking at about 30%. This is getting in an area that's more normal for big capital investments in the energy business. And even then, I think it might be a little bit of an understatement. And that scrub rate could potentially be higher than the numbers we're looking at. And again, going back to this, now we're down to about 57 billion in LNG and 47 billion in non-LNG for the total Gulf of Mexico region. Looking at exports overall, what has propelled a lot of our energy exports starting in about 2015 has been our refined product, and moving a lot of refinery products and refined products out of the United States and into other markets, particularly developing markets. We've had strong utilization. But as Greg mentioned earlier, in last year's GCEO, we were looking at a trailing off of that and a slowdown of that, primarily because of the trade tensions and the reduced economic activity that were associated with those trade tensions as we moved through 19 and we were finishing up 19 and moving into early 2020. As Greg mentioned, and I do want to reiterate, and I think some of these charts will underscore that, we were looking at a pretty weak environment as we moved into early 2020. And you'll see that that had started even before coronavirus actually started to kick in. And what I'm going to do is go through a couple of slides that'll give you this longer run picture, and then we'll drill down into the more monthly numbers so that you can see that more readily. But again, that utilization starting to tick down as we moved into the end of the year. These are the monthly numbers as we've moved through the beginning part of this year. And you can see that precipitous drop for refining utilization. The goal being the U.S. overall refining utilization rates, the purple number, the purple line there representing PADD 3 or the Gulf Coast. A couple of takeaways on that: really substantial reductions. Those reductions were starting earlier in the year, even before we went into the lockdown. And again, part of that had to do with some of the Asian lockdowns that started earlier than we did, but a lot of the weaknesses that were going on in those Asian economies that preceded that lockdown. And again, just the free fall as we moved into lockdowns in the United States. The other takeaway on this is that we're about a 5% percentage point differential or difference between the U.S. averages and the Gulf Coast. These are the refineries here that tend to be more efficient relative to those throughout the United States. And I would also argue, even though these numbers tend to be confidential and not widely reported, if you look at within PADD 3 and the differences between Texas and Louisiana, and even within Texas, you're going to see some variability and differences there too. Again, looking at the big picture on refined product across different product types, you see again that weakening that I was talking about earlier as we moved into 2018 and 19, the early part of 2020, and then bringing this down into the monthly data. Again, you see that early contraction moving in January, the end of the year, as we started, and then as we moved into the COVID lockdown period, you see those numbers falling like a rock. One of the things when we were putting this together, Greg called me and said, "David, you've got jet fuel here in the legend and we can't see it." I'm like, "No, it's in there. It's just so small that it's very difficult to see. You blow out this chart, you can see it a little bit better, but you can see that huge reduction primarily due to the fact that nobody's traveling anymore. And those numbers continue to be relatively small. Again, working backwards to the longer run trends in refined products, as I noted before, early part of the decade, we started moving into a net export situation on refined products. This started that trend of energy dominance from the United States that expanded into commodity chemicals, expanded into natural gas, and then ultimately into crude oil. But you see this big run up and again, softening as we move through the end of the historic period here, as we were moving into 2020 for last year's GCEO. And then the monthly numbers, again, they start to show that contraction early in the year, a fall off, and again, reductions in motor gasoline and middle distillates, in particular, jet fuel, diesel, heating oil, all those commodities that wind up getting impacted pretty negatively due to the lockdown, particularly in the commercial loads and some of the industrial loads as well. Working our way back to exports and crude oil. Important thing to keep in mind, and the thing that we may have some discussion on later, is the release of that export restriction in 2050. This is going to be something that will be probably a political hotball to play with as the new administration starts to kick in. You can see the explosion essentially in exports moving up to about 3 million barrels a day. A lot of that coming out, in fact, I think most all of that coming out of the Gulf Coast region, parts of that coming out of Lute, parts of that coming out of Corpus Christi, and some out of Houston as well. Big growth opportunities as we started to transform the Gulf Coast economy into one that is moving away from just serving the domestic markets here to those big growth markets in international trade that we talked about in the last year's GCEO. But again, that weakness was starting. When we go to the month numbers, you start to see that start to peter out as we peaked at the early part of the year. Then that kind of free fall as we move through the lockdown period. We're back up now, but certainly not where those peaks were. And as Greg mentioned before, on a lot of these numbers, you're going to see these trajectories where we were moving in one direction and we've had essentially a permanent, intercept shift, a whole trajectory shift that is going to be hard to get back to trend on some of these things because we've just taken this huge hit. And the other thing that we don't realize or understand at this point is just what are going to be some of these behavioral changes that arise on energy demand, not only domestically, but internationally as well. That those sectors won't be immune to those changes as well. Again, the big corrections in petroleum demand globally, as well as the United States. And again, if you kind of were to just take a simple line and just look at that trajectory, for the world as we were moving through prior to the pandemic. And then you look at what this trajectory is looking like now, there's just this kind of differential between those two lines that could be anywhere from 5 to 10 million barrels a day that just may never get made up. And if we continue to see behavioral changes and some of these lock in and stay pervasive as we get into this recovery, it will have a big difference in terms of where we go for the U.S. as well as for global energy demand. Now the outlook for exports is a lot lower than we were, probably by about as much as a million barrels a day as we move into 2020 and 2021, 22, 23. Lastly, looking at LNG capacity development. Again, on the bookend, we're looking at as much as 60 BCF of demand a day on announcements in terms of export capacity. Obviously, not all of that is going to get developed. We've seen a crashing in essentially global prices for LNG imports, particularly in Asia, where a lot of this commodity is moved to. The prices in Asia are almost comparable to the hub, which makes it very difficult to collect gas, liquefy it, put it on a boat, and send it to Asia when those price differentials aren't enough to sustain a lot of those big investments that help convert that gas into a commodity that's used in global trade. So right now, I'm looking at this, you're looking at about a 50% reduction in that capacity development. And then even then, that might be challenged not only by continued economics, but by what goes on in Washington, D.C. and a new administration that is probably going to look at these issues in a much different light than what you've seen in the prior administration. So Greg, I'll turn that back over to you to talk about the employment.
All right, so next we're going to move into our employment forecasts. So really what we've done here is we sort of take everything that we've done up to this point, and we use that in order to create employment forecasts. So let me talk very briefly about how we do this, sort of what the methodology is. Of course, this outlook is more focused for the general public, policymakers, so we don't get into the modeling and math, if you will, in the document itself. But what we do is we look at the podcast model and we look at the value of the oil and natural gas production into the future. And then we multiply that by the futures markets prices to get this sort of idea of what's the value of production that's likely to be produced. And then we look at the historical relationship between that value of production of what's produced and how many billions of dollars of value production does it take to support so many jobs. And then we will use that to extrapolate into the future. And so when we do that, this is what we find. This is the employment forecast for Louisiana upstream oil and gas industry. As you can see here, prior to 2014, really we were bouncing around from sort of this 45,000 to 55,000 workers directly in the oil and gas extraction and services sectors. And this, of course, would go up and down with the oil price and natural gas prices, especially with the Haynesville boom. And then in 2014, as you can see, we went from over 50,000 jobs to almost 30,000 jobs. This was a very big hit to this industry. And interestingly, if you look at the whole U.S. economy and compare it to Louisiana, Louisiana went into a sort of mini recession at this time, while the rest of the U.S. economy was still in expansion mode. And my personal analysis, I attribute that a lot to this particular sector that was hit pretty hard, despite the fact of all the industrial construction that was going on that we'll show here in a minute. Then, of course, COVID-19 hits, and we went from this, we'd come back to about 34,000 jobs, and now we've bottomed out at about 26,000 jobs. This is the lowest level in modern history in Louisiana. We anticipate that we'll gain about 2,200 jobs back by October of 2021. So about a year after the bottom, we'll gain about 2,200 of those jobs back. But we're anticipating that employment will be relatively flat thereafter, and we're not forecasting that we're gonna return back to the pre-COVID level, and certainly not forecasting that we're gonna return back to the pre-2014 price crash level. So that's frankly not a very optimistic forecast for that part of the industry. This is what you get for Texas. So Texas, of course, you see a very different trend here. You had the boom in pre-2009 with natural gas, and then the bust when the natural gas price dropped. Then again, the boom whenever you had the oil production, the Permian was booming. And then in 2014, you again had the bust. The difference between Texas and Louisiana is they've got the boom periods and then the bust, but then after they always come back with that boom. And so now we've got here over the last year, and by the way, last year's outlook, we were actually forecasting that even as production was increasing, we were forecasting that employment in Texas was actually going to be reduced. And that did bear out similar to what the forecast was. But of course, once COVID hit, they got hit very bad. And so they bottomed out, we think, at about 168,000 jobs in October. They'll gain about 14,000 jobs back, according to our modeling, by a year from now. But even with Texas, given what the futures markets are, what the production forecasts are, et cetera, we are not anticipating that they're going to bounce back to a pre-COVID level within the forecast time horizon. So now let's move to, so I want to show a thing here, okay? And this is part of the modeling process where we think about, when you add up Texas and Louisiana upstream employment, what share of that comes from each state? And so what you can see is in 2006, you had about a little over 20% of that cumulative employment was associated with Louisiana. And that had this sort of long-term downward trajectory. And in prior years, GCOs, we had sort of assumed that this long-term downward trajectory was going to continue in the future in creating our forecasts. What's been interesting here is that this time, what you had was you had all this employment drop in Texas and Louisiana, but on a percentage basis, Texas got hit harder in this industry than Louisiana. And that ties back to that rig count figure that I showed at the beginning, which is over half of the rig count adjustment in the United States during COVID has been in the Permian Basin, of course, in Texas. And so what we've seen is Louisiana's share, even though the total employment has gone down, has gone up. And what we attribute this to is the fact that the offshore industry has been incredibly resilient through this time period. And generally speaking, is less susceptible to these business cycle shocks. And so as Louisiana's upstream employment is being more and more concentrated towards that deep offshore production in the Gulf of Mexico, we anticipate, of course, barring political risks that we talked about earlier, for Louisiana's upstream sector to actually be less sensitive to oil price shocks than Texas and the U.S. as a whole, for instance. So that's some relatively sort of a silver lining. This is the employment for refining and chemical manufacturing. So we anticipate, again, sort of this sort of like slow, mild growth as the industrial expansions happen. So how does this model work? We take David's work on the industrial expansions. We look at the historical relationship between employment growth and the amount of CapEx that happened in the two states. And then we extrapolate those relationships out into the future. And as you can see, because we had this sort of COVID slowdown where we're anticipating those to slow, it's going to take a few years. We'll have we anticipate to be relatively flat this year, about 0.8% increase. But then over the next 2 years, it'll accelerate a little bit, hopefully when that global demand comes back and a lot of those projects are able to continue again that likely, frankly, were delayed because of COVID. One thing to take into account here is that the Convent refinery perhaps closing has not been taken into account, and that's 700 jobs. And so we hope that that refinery is able to sell, but if not, you could sort of subtract that out here. And as you can see, that'll get us back to that pre-Convent closure sometime in 2022. Okay, this is Texas. You see a similar sort of trend here. You've got sort of a little bit faster on a percentage basis. But the reason for that actually is because they actually saw a reduction, a fairly sizable reduction this last year. And so they should get back to their pre-COVID level at about 2022 and then see a little bit of growth after that. The next thing I want to show here is this is Louisiana and Texas, the upstream, which is oil and gas extraction and services, alongside the downstream, which we sort of think of as energy manufacturing, which includes that refining, chemical manufacturing, and export sectors. And during the 2014 crash, that energy manufacturing sort of surpassed the amount of upstream employment in Louisiana. And I'll show a little bit more about this in a second, that if you take into account the multiplier effects of those industries, it's even larger. When you look at the same thing for Texas, that's just not the case. And so while Texas has more jobs in that sector, they're just a way larger state. The relative importance of energy manufacturing in Louisiana has been increasing, and we anticipate will continue to increase into the future. And so when we think about our industry, that's something very important to think about. So one of the things is, could you say, man, this refining and chemicals was completely spared from COVID. And when I looked at the data initially, that's, what you might think. But when you talk to people at these plants, what they tell you is when the COVID shutdown happened, the companies wanted to keep their core employees. And so what did they do? They kept their core employees, the people that work actually for that company. And what they were doing is laying off or not continuing a lot of the contractors in the interim time period. And so when you look at the economic multipliers, if you will, in the refining and chemical manufacturing industries, you have about 5 workers in the whole economy for every 1 worker in those industries. And the reason is the increasing importance of these contractors. So what industries are those in? Well, they're in the construction industry, which has been hit very hard here in Louisiana. Now, of course, not all of this comes from that one sector, but certainly some of them are, as well as the architectural engineering and related services. So this is, you can think of, a chemical engineer that's contracted out to do a turnaround, for instance, and reprogram the computers, et cetera. And so again, this has been hit really hard. So I just want to say that, when you think about that industry in total, it's definitely been impacted by COVID, but it just hasn't been in the core industry, if you will. It's been those indirect jobs, if you will, that have been that have really have had the brunt of it. So now we're going to move back into conclusions.
Greg, I was going to let you advance it if you had it on yours.
Oh, sure. Yeah, absolutely. I can do that.
So to wrap things up here, big picture, pandemic related impacts are not over. They're likely, but as our forecast shows, I think a lot of other independent forecasts show some normalcy is returning. As the economy improves, I think all of the energy sectors will start to come along with that. The real question out there is when is that process going to occur, and how fast is it going to occur, and what sectors are going to be moving quickly? There's not going to be an equal distribution in this recovery. Some sectors are going to be very, very long in terms of returning back to normal. Think of travel, think of hospitality in particular, several others. Production is going to be down somewhere around 2 to 3 million barrels a day from its pre-pandemic levels. And as the forecast shows, and as Greg alluded to earlier, it's likely to remain flat. Same is true with natural gas. We're not going to get back to levels where we were pre-pandemic for several years, probably at least a year or two, if maybe not 3, tends to be the conventional wisdom, not only in the things that we're looking at, but if you look at other people's forecasts that are starting to come out now, I think that's true as well. And then you've got this uncertainty associated with what's going on with the election, the moratorium on federal leases, which could impact that as well. It may be that the Biden administration is able to do what the Saudis and the Russians haven't been, and that has been to curtail U.S. Unconventional production by several million barrels a day. Keep in mind that some of the most productive places in the Permian Basin are in eastern New Mexico, which carries a lot of federal leases on it. The Texas side tends to be more private leases, but you certainly have a lot more public lands in the eastern part of New Mexico than you do in other places. Obviously, the Gulf of Mexico is another area that's a little under 2 million a day that could be significantly impacted by this as well. So that's the uncertainties associated with where we go on a foregoing basis with production, and we can talk some more about that later. As Greg mentioned, prices are going to follow that kind of range-bound area that we've been in between 40 and 50, and I mean really probably between 41 and 49. On any given day, you're going to see some volatility on news. The good news tends to pump things up like we are today. Sometimes you get some bad news. It's looking like going back to July to today, every 3-4 weeks, we get something that rattles everybody's cages. We get down into the 30s. And then we kind of pop back up. We stay kind of range bound in that $40 mark. We're at 42 today. We had gotten back a couple of weeks ago down in the upper 30s. That's what you're going to continue to see probably in the near term. And what's going to be probably likely as we move through the next year, and essentially where people are trading right now. Midstream part of the business, again, is going to be challenged by what has been going on demand related side, but I think that's the real vulnerability from political changes right now, going in and citing new capacity and getting federal permits, particularly for interstate systems, is going to be increasingly difficult. For refineries, another difficult sector, flat line on capacity growth is very likely. More contractions, more potential geographic compression. And what I mean by that is people doing essentially what Shell talked about in making the announcement on Convent, and that is focusing on their high value assets and high profitable assets. And I think it's important to keep that in mind. There's been this myth or perception that just because big companies have big capital investments in these in this region that they won't just get up and leave. And I hope that people have been disproved of that myth with this announcement, particularly in the environment that we're in right now. It's a very tough one. There is a lot of intra-company competition and intra-refinery and intra-chemical plant competition. So everything matters, and it matters at the margin too. And that's another thing to underscore in all of this. And this is going to be a time period over the next year or two where you're really going to get to see that. Because those facilities that are profitable will get the continued capex and investment, and those that are not will probably go by the boards. Hopefully they'll be resold off to other players, and hopefully we don't see this kind of situation that we've seen with Convent. Exports, they're going to be driven by what goes on in Asia. And fortunately, in terms of green shoots and what's going on in the global economy, that tends to be one. We are seeing for some pretty strong recovery, particularly in China right now. However, again, that's a sector that carries, I think, considerable political risk with trade negotiations, which we don't know where the new administration is going to sit on this. I tend to have a little bit of a bias that they're going to probably continue, probably with a much softer finesse, but continue some of the tough negotiations that we've seen over the last 4 years. And then lastly, on power, this is a sector, in my opinion, that's probably going to see a lot of growth opportunities as we move into the next year and the next administration. And I don't mean that being generated by load growth as much as I am just new capacity opportunities and new investment opportunities. Essentially, you're going to wind up seeing a lot more opportunities in renewable capacity, but increasingly in technology. If you go back and you look, essentially, I think you're going to see, another Obama 2.0 here, essentially with the ARRA, which had a lot of investment spending associated with the power sector. Back then, it tended to be in renewables, tax extenders, loan programs, things of that nature. Smart grids, distributed grids were big then. I think the next go around, probably see a lot of investment in battery storage, again, technology, things like blue hydrogen, other types of investments that are kind of on the edge right now that aren't commercially available. Those are the things that you're likely to see in those sectors. They create big investment opportunities there. And so if there is any kind of optimistic light in terms of looking across energy, I think that's going to be one of the ones that you see those big opportunities for. And with that, I want to thank everybody again for participating in the Gulf Coast Energy Outlook. We've had an amazing level of participation, and in looking at the numbers, they've gone up. They haven't gone down as we've been talking. We really appreciate people taking the time out of the day, and I'm going to turn it over to Greg now to manage a couple of minutes that we can dedicate it off to some questions and answers.
Yeah, so we have a few questions here. I'll sort of go through them. And of course, if you have any questions, you can please type them in the Q&A right now. So the first is, what would drive oil production growth in the second half of this decade if prices stay at the current level? Capital has been driven out of the shale plays by economics and exploration of the best rock. And so this is a really good question. And so when we think about, a price bust, what we think about is companies are going to stop drilling those sort of the next least productive wells. And so the wells that come offline are the ones that are not drilled, or those less productive wells, and they'll focus more on just the productive ones. And so while you might see rig counts that drop a whole lot, what you find is that production doesn't drop by that same percentage, if you will, because of that fact that you're still going to drill the lowest hanging fruit first. David and I were actually at an event about a few years ago, and we saw Harold Hamm speak. And this was right after the 2015 crash. And he said something that was just, I thought, very interesting. He said, the companies that are well positioned, when that bust happens, that's when they have the opportunity to learn. Okay, if the price is really high, times are good, you're not going to experiment with a new well because the opportunity cost of doing that's very high. If the production doesn't come in what you thought it was, well, you've lost all that revenue. But when the price is really low, the opportunity cost of experimenting is also lower. And so it's really that time in a strange way. It's that low price time period, it's that time for experimentation that really can drive that innovation into the future. And so I think how the model works is that you'll have wells will stop being produced. They look at the whole amount of reserves that are there and they say, well, those reserves are still in the ground. And then they'll model how many wells will be able to be drilled and what the production of those wells is, giving this sort of low hanging fruit idea that'll be the most productive wells that are drilled. And when you model that out, what it takes is about 3 years for production to tip up again. So that's a really very good question. The next question is, what will be the future of deep offshore oil production, not counting the political environment? My personal view is that I think that the future of offshore is bright. I think there's a lot of room for technological advancements there. I think there's also a lot of room for having production that you drill a well, you produce it, you play out a field that's going to produce for decades and decades time horizon. That provides a lot of certainty to the refineries that are purchasing that oil, a lot of certainty for the investments, for the investors that that's going to continue for a long time. And so the big thing we've been watching over the last few years in the offshore space is those costs. And those costs have been very important and they've been coming down and there's been more consistent, consistently be able to hit these fields and produce them at a lower cost. All right, so let's see here. Would you discuss the Louisiana drilling rig forecast? We actually don't have a forecast for the rig count itself necessarily, but we do show the historical decline. And, we think that rig counts will pick up, of course, from this COVID low. But unfortunately, we don't think we're going to, have a level back to pre-2014. Anytime soon. So that part of the industry has definitely been hit hard. Okay, are there any state incentive structures or legal frameworks to explain Louisiana compared to Texas? David, I'm gonna push this over into your court.
Yeah, I haven't. I mean, we haven't done that per se. I know Greg's done some stuff on the mineral side, but we haven't gotten into the whole panoply of incentives and how they impact on the CapEx side. Let's just say that being competitive is really, really important. And it can be very difficult to make those kinds of comparisons, particularly as you move away from, say, an E&P. I don't want to say that they're relatively homogeneous, but a straightforward E&P type investment to one that gets into energy manufacturing where each facility can be different. Keep in mind that these are the times that make things very, very tough for firms, and they're going to be making those decisions. And what may seem like very generous incentives are things that may be the kinds of things that keep these jobs alive. As Greg mentioned before, we're not looking at big movements in the upstream E&P side of the business in Louisiana. And so if we're going to be looking for these opportunities, as Greg said at the onset, they're going to be in that midstream part of the business, in the refining part of the business, in the petchem side of the business. These are the investments that leverage 80,000 plus a year jobs with benefits and the things that you want to see in terms of growth. And if we get less competitive, that's going to be problematic, because that is the one saving grace that we have right now in terms of economic development opportunities.
And on the upstream end, as David did mention, we did put out a report earlier this year that was actually requested by a resolution from the legislature on making very broad recommendations on the severance taxes. And essentially what we're recommending is to broaden the base, remove a lot of exemptions and lower the rates. In particular for oil would see a rate reduction. Natural gas actually would not, because they have a way lower tax burden right now. But all those were more revenue neutral kind of recommendations. Okay. The next view, what are your views on Gulf of Mexico oil and gas service sector providing services to wind projects offshore in New England? David, I think you're probably the best to answer this one.
There's opportunity. I think Gulf Island already is participating in one of the big projects up there right now on construction and manufacturing. This SWESH deal that Greg alluded to earlier is something that has opportunities. And they will for the business entities that are doing that here on the Gulf Coast. But do keep in mind something that does need to be considered, and that is, most of those projects that are getting developed here in the United States, and there is a big growth opportunity. I think offshore wind is going to be another area where you're going to see a lot of development over the next in this administration and over the next decade, because the costs there, while still expensive, have come down by about half of where they were about 5 or 6 years ago, even. But one of the problems is when you get into those environments, and I've worked on a number of those projects in the Mid-Atlantic, they usually have local content requirements and siting requirements and other types of promises that need to be made in return for these long-term contracts which securitize those investments. And so while it may be good for these businesses, I don't know that, we're going to be manufacturing big caissons and platforms and structures and nacelles and other things and hauling them up to New Jersey or to Virginia or to Rhode Island, for that matter. I mean, a lot of these states are strongly looking for that local content requirement. And in fact, bids and bid awards are often, because they're all done through competitive RFPs, are often determined on the type of local content share that you have in that. So while it may be good for a lot of these companies, and there may be some Louisiana people that will participate, hopefully they don't all get moved up there and transfer that economic activity up there. But I would be cautious about, really ginning up a lot of activity for us from up there. I think in order to make a lot more jobs here in that sector, you're going to have to see more getting developed in the Gulf of Mexico proper for that to happen.
All right, so we've got a lot of questions. We'll do one or two more. I know we're a minute over. This one might be interesting. David, do you think that that the continued growth of renewables is going to be more focused on utility scale and traditional regulated utilities building renewables, or where do you think that growth is going to come from?
Yeah, I mean, it depends on numbers versus capacity. Most of the capacity is going to be at grid scale, but you're going to have a lot of numbers down at the behind the meter level. My impression is that the behind the meter development is starting to kind of slow down. There are still opportunities there, but there's been a lot of penetration in the early adopters, at least behind the meter, interestingly, through the first ARRA or through the stimulus act that we saw the first time. We may get another boom depending on how generous those incentives are going to be. But if you really look at the cost-effective opportunities for renewable development, they're going to be at those grid scale projects, particularly with solar, which is below $1,000 a kW right now, which has competitive opportunities. Onshore wind, in particular, as well. My guess is you'll see some of these tax extenders get continued on for the next couple of years, which will keep some of these projects in the money. Not that they're not now. You may even see some slight increases back to prior levels because there have been ramp downs on both the ITC and the PTC. Loan guarantees are important in this industry too. You may see a lot of new announcements on that, and most of those inherently are for scale size projects. They're not for behind the meters type projects. They're for large projects. And again, I do think there's going to be a lot of bennies in a new stimulus plan that has a lot of green components to it that are going to be on offshore wind. I think that's going to be another, and battery storage in particular. I think those are going to be two big hot areas.
Cool. And then I know we got a lot of questions I get to. We'll do this last one because I think it's particularly interesting. David, why do you think they don't just build all the refining and chemical manufacturing and all this industrial construction we're talking about? Why don't they just build that in Asia? Why are they going to build it here in the United States and then ship it across the world?
Yeah, there is a competitive opportunity for developing stuff in Asia, and so it's something to keep in mind. It's not that you can't do it, but from an investment perspective, you're going to want to look. There are offsetting considerations that you need to keep in mind. There's labor efficiency issues. There are legal issues. There are property right issues and intellectual property. I've had people tell me in the past that they don't want to take their highest technology manufacturing facility and put it in a place that has histories of invading intellectual property rights and essentially pirating technology. So those are things to keep in mind. This is still a very productive, efficient place of the world to be. You have lots of forward and backward linkages and lots of fuel supply opportunities here for input fuels that you probably are likely not going to have in Asia. Consider every chemical plant here on the Gulf Coast usually has anywhere from 2, 3 to 5 pipeline interconnections to source natural gas that they can play off of on any given day. I don't know that you've got that kind of expansiveness and option value that you would anywhere else in the world that you would have here along the Gulf Coast. So those are some of the reasons that are promising that help keep that investment here. But do keep in mind that within the Gulf Coast, there are opportunities that some of those opportunities are pretty pervasive along the Gulf Coast. And we're going to be competing with Port Arthur, with Beaumont. We're going to be competing with Freeport, Houston, and in particular with Corpus, which has been a booming area for new investment and incremental investment. There are going to be people who are going to want to diversify that investment along the Gulf Coast, given what we've seen lately with storm activity, other things that have been going on, political risk, other things. So again, I still think the Gulf Coast and I still think Louisiana is still a great place to make these incremental investments, but we can't take it for granted. We're gonna have to fight for every dollar. And, unfortunately, I think there can often be some apathy and some inertia that gets involved in considering these investments. They've been big opportunities for us, and I think they'll continue to be opportunities for us if we want to go down that road.
Well, David, thank you so much. Thank you for everyone for attending. Thanks for everyone that we spoke to and sponsored the event. If you would like to be one of the people that I speak to next year when making these phone calls, please reach out to me. We'd love to make connections, and have a great day. Thanks so much.